Hello everyone, welcome to Yorkville's 5 Under 5 series, 5 slides on markets and economy in under 5 minutes. We hope you find this information useful, and if you have any questions regarding the content of this presentation, please do not hesitate to inquire with your relationship manager or by sending us an email. Please be aware that this presentation does not constitute any form of investment advice and is only reflective of information that is available to the presenter at the time the presentation is being made. The material presented is just for information use only. Please speak to your advisor prior to making any investment decisions.
The first slide shows the average yield spread of high-yield bonds over government debt. The spread compensates investors for the risk of holding lower-rated bonds and ranges from as low as 3% to nearly 20%. Currently, the spread is just over 5%, which is still a sign of a frothy market. Buying a high-yield bond when the spread is near the bottom of the range is comparable to shorting a stock when the price is at historical lows. The risk-reward just doesn't make sense. Some high-yield bonds are referred to as Cov-Lite, which means they have little to no covenants attached. Covenants are legal protections for the buyer that help flag cash flow issues and help protect capital in the event of a default. The percentage of high-yield bonds that are being issued right now that are Cov-Lite is over 70%. In 2008, it was considered excessive at 25%. In 2008, high-yield debt lost 25% outright and lost 40% relative to government debt. The next time high-yield debt implodes, the losses could be even greater. Slide 2 shows high-yield bond yield spreads and high-yield bond leverage expressed as debt over cash flow for small-cap stocks. Historically, the spread rises to compensate investors for the increased risk that comes with higher leverage. Except today, because of the Fed, we see leverage rising to new highs while compensation for risk has fallen. The Fed rushed in March to shore up the high-yield market to prevent the doom loop. In the doom loop, investors worry about corporate defaults due to excessive leverage and demand increased compensation by higher spreads. The higher spread increases the financing cost for the company, which increases the leverage. So investors demand increased compensation in the form of spread. The higher spread increases the leverage for the company, and so on and so on. In slide 3, we can see high-yield ETFs were just getting started at the time of the global financial crisis in 2009. Now they hold many billions of dollars. Investors like the ETFs because they are diversified and because they are large, so they're very liquid and you can sell anytime you want. But the underlying asset class of high yield is very illiquid, so this liquidity only exists as long as selling is gradual and orderly. And there's a new source of additional supply looming over the high-yield market. The largest segment of the investment grade market is BBB rated, just above the BB top rung of the high yield sector. In Q1, 150 billion of these BBB rated bonds were downgraded to junk. This is referred to as fallen angels, and there are many more BBB bonds waiting the same fate. Also note that after 2009, regulators decided to make banks safer by limiting how much corporate bond inventory they hold. While this does fix yesterday's issue, it removes an important source of liquidity from the high yield market. During the Fed-engineered recovery, CapEx has been much more muted compared to previous cycles. This matters for high-yield bonds because in the event of distress or a default, buyers will assign a fire sale price to the debt based on the residual value, which is what they could get if they sold every asset in the firm. These hard assets are normally where capital expenditures go in order to fund the future growth of the company. But in this cycle, corporations have borrowed in order to fund share repurchases, basically borrowing from the future of the company in order to boost stock option valuations today. Corporate bonds got cheap during the market volatility in March and April. We took advantage of this to increase our exposure to corporate debt, and we're planning to add even more exposure. But the Fed and the Bank of Canada have announced corporate debt support programs causing corporate yield spreads to snap tighter. Given the decreased compensation for risk and the increased risk and leverage in the markets right now, we have once again reduced our exposure to corporate debt. Once the fundamentals improve, in line with the current yields, or once the yields rise to compensate for the increased leverage and risk of the market, we'll come back in, but for now, we're staying away.
The information in this podcast does not constitute research or recommendation from any Yorkville employee or entities to the listener. Neither Yorkville nor any of its employees makes any representation or warranties as to the accuracy or completeness of the statements and any information presented in this podcast, and any related or associate liability therefore. The views presented in this podcast are not for any investor. Listening to this advice should not be considered as receiving advice from Yorkville or constituting a client relationship of any sort, even if such a relationship already exists. Speak to your advisor prior to investing. Investing involves lots of risks, and your advisor should help you in deciding on a strategy that is suitable for you.